All right, we're about halfway through earnings season for S&P companies, and so far results have come in higher than the street's estimates. Meta shares surging. Look at that. Up more than 14.5% after those solid results yesterday. The beat raising up tech stocks today. Will that trend continue? What do these better than expected results mean for the broader health of the economy? For more on this, we turn to Liz Young, SoFi Head of Investment Strategy. Always great to see you, Liz. What do you make of the outperformance of big tech thus far in the quarter?
Well, look, the earnings reports, not just from big tech, but across the S&P have been better than expected. We had seen beats and surprises now at the magnitude of about 8%. And notably, that is from lowered estimates. So, unimpressive kind of expectations coming into earnings season. But I think what happened was we had this sentiment and this sort of worry and fear that we would enter earnings season and hear about negative surprises. And that hasn't really happened, at least not broadly. There have certainly been some disappointments, but broadly speaking, earnings season has been a bit stronger than expected. The thing that I would tell investors to watch is that if you look at the numbers, if you look at revenue growth still for the quarter expected to be about 2% positive, but earnings growth expected to be negative by about 3%, which means that margins are contracting. And a lot of the story coming into this was that margins were so fat that they could absorb some of these cost pressures. But now we're seeing over time a lowering of those margins, a narrowing of those margins. So there's not going to be as much breathing room for companies. And then if you look at expectations for the rest of the year and into 2024, revenue growth is expected to be kind of paltry at best, but earnings growth, interestingly, is expected to be higher, which means that in order to do that, companies would have to cut costs even more. So this is a point in the cycle where we have to really think through what those results would look like and the effect that they might have on things like employment. Would companies have to lay workers off to cut those costs? Would they have to cut costs in other places? And that will eventually bleed through into the macro data.
So, Liz, what does this mean then for equities? Because certainly it looks like investors are getting excited about these beats, although they are beating at depressed levels. Are we going to see a downturn here in terms of some of that downside risk for the market?
So I do think that we're fragile, but I think we were kind of ripe for a move in one direction or another. I said in my blog post this week, it's almost as if we've been stuck in this range. We're on a teeter-totter that is stuck at perfectly horizontal. And any piece of news that was positive was going to send it up. A piece of news that was negative was going to send it down. So far, we've gotten decently positive news from not only some bank earnings, but the tech earnings and in some other little bright spots that we're finding. What could happen after the end of earnings season is if the economic data softens, that's where people are going to start looking at it and saying, okay, this recession that we've been waiting for, or this contraction in the economy that we've been waiting for, is now looking more like it's confirmed. And then you go back to the stock market and say, does that mean that stocks should be trading at 18.3 times forward earnings? The answer is probably not. It's not going to affect all sectors equally, in my opinion. I think if we do see an economic contraction this year, it affects those cyclical sectors much more strongly than it would affect big tech. And I think we're seeing a little bit of muscle memory of people going back into big tech and getting kind of excited and feeling like they're safe havens. But the last thing I would say on that front, especially in earnings season, is if you look at the sectors that are expected to contribute positively to earnings this quarter, it's mostly cyclical sectors plus consumer discretionary. If we have an economic contraction, those cyclical sectors are likely to take it on the chin a bit. So that would tell me that earnings expectations for the rest of 2023 might still be a little bit lofty.
Fascinated how you call this purgatory of the worst kind for investors. What is the data, though, Liz, that you're keeping your eye on that could send things, the S&P, to the downside?
Yeah, the purgatory is not only this trading range, but that we haven't really gotten a definitive answer in either direction of whether or not the economy is actually going to slow and contract. So the data that would send it down, and we got some data today that wasn't great in the form of PCE and core PCE for the first quarter. It actually ticked up compared to the fourth quarter. Obviously, that is the wrong direction. So as the Fed continues to fight inflation, we certainly don't want to see inflation rising. I think the risk that we're probably running right now is that it actually stays stable and services inflation doesn't come back down. The other piece that I would be watching is the services PMI data. So there are two types of PMI. You've got manufacturing PMI, which has been signaling contraction for some time, but the services PMI has been inconclusive and sort of hovering around that neutral range. If and when that dips into contraction territory, that's a pretty clear signal from macro data that things are getting worse before they get better. The market, the bond market in particular, is sending a lot of warning signs, a lot of signals that say things are probably going to get worse in the economy. It's just that usually those signals go off quite a bit before we actually see it in the data.
So Liz, talking about what all this means then for Fed policy, market right now pricing a 90% chance that we get a rate hike next week. What about June?
So this is such a tough one to answer, right? Here's the thing. Jerome Powell, I don't think, likes surprises. So if we go into next Wednesday and there's a 90% chance still priced into the market of a 25 basis point hike, that's a pretty safe bet that they're going to raise rates by another 25 basis points. My personal opinion, and he doesn't call me for my opinion, the Fed doesn't care what I think.
We do, Liz.
But my personal opinion is that I don't think 25 basis points at this point makes much of a difference. And it does send the signal that they are still fighting inflation. They still think inflation is a problem. I guess if they raise rates by 25 basis points next week, it probably prevents a rally in growth stocks and sort of exuberance in the stock market that could make things tougher down the road. So I would expect them to do 25 next week. I think they're probably done then. But then again, I said that last time.